Natural disasters strike without warning, and their ripple effects are felt instantly across economies and markets, including Forex. But how exactly can traders assess the impact of a natural disaster on currency values? That's what we're going to unpack today, because in a market driven by speed and precision, your ability to analyze these events quickly can make or break a trade. First off, let's talk about fundamentals. Natural disasters can lead to billions in damages, disrupt trade, and even shake investor confidence. One of the best ways to gauge the impact is by looking at economic indicators, things like GDP, employment rates, and industrial output. A hurricane wiping out a major export region, that's going to show up in GDP forecasts. Wildfires shutting down infrastructure. Expect consumer sentiment to fall. Watching these indicators gives you a clear idea of the longer-term currency direction. Next, we look at sentiment. How are investors reacting? Are they pulling capital out of the country? Are they flocking to safe haven currencies like the Japanese yen or the US dollar? Tracking market sentiment through news feeds and investor behavior is key. If confidence in a country's recovery is low, the currency usually takes a hit. But if the government responds quickly and effectively, that might limit downside pressure. Now, let's bring in technical analysis. Even if you're not a chart expert, understanding support and resistance levels during a crisis can give you clues on where the market might stall or reverse. After a disaster, price action is often erratic, but those zones can act like psychological barriers. Tools like automated trend lines, Fibonacci retracements, or pivot points can help you identify potential entry and exit points, especially during volatile swings. This is where having a smart trading system really comes into play. Something like the Trading Management Solutions EA can help you process all of this in real time. It scans markets, evaluates trends, and executes your strategy without hesitation. So, if you see a weakening currency and want to capitalize quickly, the system helps you act instantly without second-guessing or manual execution delays. Another method is watching the currency strength meter. If a natural disaster hits, you'll often see that countries' currency weaken against others. Let's say an earthquake strikes New Zealand if NZD starts showing up as one of the weakest currencies, and the yen is strong. That NZD short might be worth looking into. The meter helps you pair strong currencies with weak ones for better trade setups. You can also track news using AI-driven tools. Real-time news monitoring helps you stay ahead of the market narrative. Are investors panicking? Is the central bank stepping in? These headlines can move markets in seconds. A tool like TakePropips EA even offers AI-based news and market sentiment analysis, which is incredibly useful when things are moving fast and you don't have time to dig through dozens of headlines. Lastly, don't underestimate historical patterns. Go back and study how previous natural disasters affected the markets. The 2011 earthquake in Japan, Hurricane Harvey, the Indonesian tsunami, each had a different economic fallout, but there are similarities in how currencies responded. Recognizing those patterns lets you build better forecasts and refine your risk management. In the end, assessing the impact of natural disasters in Forex comes down to a combination of fundamentals, sentiment, technical analysis, and automation. By staying informed and using smart tools, you're not just reacting to chaos, you're positioning yourself to trade with confidence and control.